Your bank is not your partner. It is a business. And every month, it charges you for the privilege of holding your own money. Most people know this somewhere in the back of their mind, but they've never sat down and added it up. The number is almost always higher than they expect. And the fees doing the most damage are almost never the ones they're watching.
Setup. Think about what you paid your bank this year. Monthly maintenance fee? Maybe $12, maybe $15. Overdraft fee if you went under, $35 at most major banks. Out-of-network ATM fee, wire transfer fee, foreign transaction fee, paper statement fee if you never turned it off, minimum balance fee if you dropped below the threshold one Tuesday in March. Most people, when they add this up honestly, find they've paid their bank between $200 and $400 this year. Not for advice, not for returns, not for anything that builds their wealth. Just for access to an account that holds their own money. That is not a partnership. That is a product. And you are the customer being charged to use it. The people who quietly accumulate real wealth understand this clearly. They looked at the banking relationship for what it was, and they stopped paying for it.
Beat 1. The fee you see and ignore. The monthly maintenance fee is the one most people notice. Most banks charge between $10 and $15 every single month. That's $120 to $180 per year for nothing. Not for investment advice, not for financial planning, not for any service that improves your financial life, just for having the account open. Most banks will waive this if you meet certain conditions. A minimum daily balance, often $1,500, or a monthly direct deposit above a specific threshold. Most people don't bother to find out what those conditions are. They see the fee on the statement, register mild annoyance, and move on. That mild annoyance, multiplied over 10 years, is $1,200 to $1,800. Not invested, not saved, paid to a bank for the privilege of existing as their customer. One phone call or one account switch eliminates it entirely. Most people never make that call.
Beat 2. The fees you stopped noticing. The maintenance fee is visible. It's the one you've probably seen. The fees that cost more are the ones you've stopped looking at. Overdraft fees averaged $35 per occurrence at major banks in 2025. One miscalculated purchase. One payment that clears slightly before the deposit arrives. $35 charged on money you didn't have. For customers who overdraft just 4 times a year, that's $140. 4 small mistakes, $140. ATM fees are quieter, easier to rationalize in the moment. $3 here, $2.50 there. The average American uses an out-of-network ATM roughly twice a month. That is $60 to $90 per year, not in withdrawals, just in fees on top of the withdrawal. Foreign transaction fees run between 1% and 3% on every purchase made outside the U.S. Traveling, shopping from international retailers online, using services priced in another currency. Every one of those transactions has a quiet tax attached to it. Wire transfer fees, returned item fees, paper statement fees. Each one is small. None of them is announced loudly. Together, they build a number most people have never sat down and calculated. And the number, when you finally look at it, is never as small as you assumed.
Here is what that number looks like over time. Not this month, over a decade. And here is exactly what to do about it. Beat 3. What it actually costs over time. Take someone paying the average in annual bank fees. Monthly maintenance, $12. Overdraft fees twice a year, $70. ATM fees, $72. Wire transfers and miscellaneous charges, $50. That is $204 per year. Unremarkable. Easy to ignore. But $204 per year invested in an S&P 500 index fund at a 10% average annual return over 10 years becomes $3,536. Over 20 years, $12,958. That is not a life-changing number, but it is nearly $13,000 handed to a bank instead of kept. Not because it was required, because no one ever stopped and calculated it. The people who build quiet wealth treat small amounts seriously. They don't look at $204 and see $204. They look at $204 and see what it becomes when it is no longer wasted. That shift in perspective is not complicated. It is just rare. And it starts with adding the number up. Beat 4. The 3 moves that fix it. There are 3 changes. None of them are complicated. Move 1. Switch to a no-fee account. Online banks and credit unions charge nothing for a basic checking account. No monthly maintenance fee. No minimum balance requirement. Many reimburse ATM fees nationwide, automatically, every month. Major traditional banks compete on brand recognition and physical branches. Online banks compete on the actual product. The product is better. The price is nothing. Moving takes 1 afternoon. Move 2. Turn off overdraft coverage. This feels counterintuitive. It sounds like removing a safety net. It is not a safety net. It is a $35 fee your bank collects every time the net deploys. Turning off overdraft coverage means the transaction declines instead. Inconvenient once, free every time after that. And it creates the behavioral adjustment that makes overdrafts rare in the first place. People who cannot overdraft learn their balance quickly. Move 3. Pull your fee history. Log in. Find 12 months of statements. Total every fee line. Not transactions, not the balance. Just fees. Most people have never done this in their lives. The number they find is almost always higher than they expected. Seeing it as a single annual total, not scattered across 12 separate months, is usually enough to make the switch immediate.
Beat 5. What the switch produces. This is where most financial content ends. Name the problem, suggest the fix, close the video. But the real outcome is not just the fees you stop paying. Someone who eliminates $200 in annual bank fees and redirects $17 a month into a high-yield savings account, nothing else changes, just that one redirect, has accumulated $2,500 in 4 years. Not significant on its own, but the habit that created it is. The person who audited their bank fees thinks differently about every recurring cost after that. The subscription they forgot about. The service they've been paying for and haven't used in 4 months. The renewal that quietly charges every November. Every one of those is an annual cost with a future value. The person who learned to see bank fees clearly now sees all of it the same way. Not because they became more disciplined, because they started treating small amounts with the same seriousness they give large ones. And that, more than any single fee eliminated, is what changes the financial trajectory.
Closing setup. Your bank did not design its fee structure to benefit you. It designed it to generate revenue from inertia, from customers who see the charge, feel mild frustration, and don't act. Most people are that customer, not because the switch is hard, because no one told them to add it up. So add it up. Pull 12 months of statements. Total the fees. Then decide whether you want to keep paying them. The people who build wealth quietly are not paying their bank to hold their money. They switched. They redirected those fees into accounts that work for them. And the bank they moved to charged them nothing. The math is not complicated. The decision isn't either. Remember that.